over to you.
Thanks, Matt, and everybody, and congrats, Matt and team, for doing this insane event, and glad to be a part of it a little bit, and hope you get lots of sleep. So I'm going to come from the perspective, I'm an angel investor, just through syndicates. So I invested about 135 startups, and 95% focused on social impact, sustainability, ed tech, fintech, and other future work stuff, and also inclusion and diversity. Also professor for many years at Georgetown, so I teach on this. But I'm actually coming at this more, I have a small social enterprise, and a lot of what we do is work with impact professionals from around the world. So people working across social impact sectors. And one of the things, both as a professor and as an investor and as a mentor and working with social impact professionals and students all over the world, I am constantly shocked how few people who actually think about their finances in any capacity. So they might be fortunate to have a little bit of retirement money, but they don't look at where it goes. If they look at the bank, they don't look at it also. To me, the lack of financial literacy for people across, I'm talking about humanitarian professionals and development professionals and peace building and social justice and inclusion. Obviously, I think most people I know in the finance and impact investing world are pretty sophisticated, but not all. So to me, so many people are not realizing that the work they do on a daily basis is essential to making a more just, equitable, and fair world, but they don't think about money, and they don't think about wherever they choose to park, save, or invest their money sometimes could have a huger impact or a bigger impact than their actual work, because we need to move every dollar at least to not doing harm in the world and ideally doing something positive. I think that's kind of the perspectives. These are just a couple of thoughts. And then one of the things I find, I've been teaching on business and social change and finance for a long time, in public investing and impact investing. I'm also the dominant approach to sustainable investing, whether it's SRI investing or ESG investing. I've seen estimates from some places that say 30 to 40% of all publicly traded ESG investments, whether it's an ETF or a mutual fund, there was a study that came out about 2 years ago, I think by the US Social Investment Forum. I'm not sure exactly who did it, but they came out like 30%, or two academics did it in partnership with someone else. And they said about 30% of all funds they looked at, investment things that were labeled ESG, actually were not. I have not done applied research on this, but I've done a lot of thinking and work. I haven't run the data, but in my opinion, 95 to 90% of things that are labeled ESG or SRI are complete crap, and that they are investing in companies that might be good for one thing, such as inclusion and diversity or equity or gender representation. But many of the companies that are in publicly traded ETFs and mutual funds, and I'm talking about both from the good guys or good people like Calvert and Pax, but also the ones like Vanguard that are very questionable. I would say 95% of the portfolios that they put their money in are just so far from what we need to do in the world. And again, I haven't run the data for that. So, and then a lot of the companies that are offering supposedly green, and I'm talking about the public markets, I think it's much different in the private markets, particularly in angel and impact investing, not so much in venture. Most places that have ESG or SRI or funds charge higher fees for things that are still crap. So as an investor also, even if you put I was professor full-time at Georgetown for 10 years, and the retirement options we had, I still teach there, but my retirement's not there anymore. The retirement options we had, it was Vanguard, which obviously is the best for fees, like really good for low fees. They are amazing for that. And diversification is important. So I put whatever, like 10% of my retirement into a standard Vanguard FTSE rated ESG mutual fund. When I dig into that and look at it, it's shocking to me, the companies that are in those places. So this is one of the things. So, but also they're charging generally higher fees. So just a couple of points, and then I'd rather have a conversation. Actually, true, false stuff. And I think everyone here would know this. I'm going to just read out two of these from my interactions with people. So the first one, and if you think it's true, you can put true in the chat. If you think it's false, you can put false. So the first one is that your financial decisions can actually have a bigger impact than your individual actions. So, like I live in Medellin, Colombia, we compost, we try to recycle. They have this really great thing. It's amazing in Medellin. They collect all the plastic we produce. We try to stuff it into plastic bottles and they collect that and use that to like do really innovative social projects. But can your financial choices or do your financial choices, if you have any capital in a bank or retirement or into investing, can that have a bigger impact than, sorry, my mouse just did something funny. Okay, I'm just trying to look at the chat. So I think most people say true. So I think, in general, I think if you have any excess capital, obviously if you're a brilliant social organizer or communicator or campaigner, you're going to have a huge impact, or a head of an organization. But I do think so many people and talking about millennials and Gen Z and they're still not really thinking from a financial social impact perspective. And the world is burning and it should be so obvious to everybody. Every single organization in the world should be thinking about this. They might make a conscious choice not to do it, and individuals. The third thing here is investing for social impact equals lower returns in the long run. Obviously, I don't live in the US now, but I am from the US. So there's the huge battle, over politicizing ESG investing, with I think it's now 5 or 6 states have outlawed it and saying like, we don't want to think about the planet, period. But if you think about impact, are you sacrificing returns? Or the same thing, if you think about impact investing, I've talked to impact investors, like, do you have to accept lower returns? So Kate's saying, obviously, if there was no money to do more drilling, like the drilling or the cost became so high to borrow money, so this is a big thing, and I'd be interested in other people's opinions. I'll stop in a few minutes. That I keep doing research in this, and I think increasingly it's starting to show that and this is just talking about public markets, not even impact investing. If you take a strong negative screening criteria, just filter out the really bad actors, or you try to do positive, that it's starting to show, it's still not universal, that investing with these criteria in mind does generate higher returns. I'm fundamentally convinced, I don't think I'm delusional, that in the long term, if we want to have a planet, money's no use on a dead planet. But if we want to have a planet that if people are investing for the 10 to 40 year range, that obviously there'll be failures. Some of the things, like there's a company I love called App Harvest. It's a B Corp. I have like 1,000 shares of its stock, and they're doing large scale agriculture in Appalachia, publicly traded, amazing, but their stock has dropped below $1. They might fail, they might not. So it's like, as long as you diversify. So I think when I'm on an advisory board of a B Corp, I think B Corps by nature, because they're triple certified, are going to be much better than non-B Corps. So I don't want to say every company that is thinking about these things is going to succeed, but if one diversifies across, solar and wind and sustainable energy and ethical products, that over the long term, you'll make more money. I'm fundamentally convinced of that. But I would be interested to hear, in the discussion part, has anyone found like universally good data to show this? Because that's still part of the battle, I think. So if the message was true, and again, we can test facts these days, so there's not agreement on facts, but if it was true, we could say over the long term, if you adopt rigorous criteria, not just slightly negative, if you don't just screen out for pornography, gambling, war, extractive, but you actually only screened in for the positive, that over 20 years, you would make a 3% higher return. Kate, you want to ask a question or make a comment?
No, there has been a lot of research and meta research around that question. The one that springs to mind, it's maybe a year or two out of date now, but Ionis, I think his name is, a professor who was at London School of Economics, now at Harvard, with a few other researchers, has done a lot of that metadata and released a few studies on that, showing, and what they were showing is that it was, if you invest in if the company is working on the material, environmental, and social issues, so they're not just doing a little greenwash thing over here, but they're actually dealing with the fundamental human rights and environmental issues facing that company, and they're doing it with a strategic and business model relevant program. And it's a competitive approach. So they were saying there's nuance to it, essentially. It's not about just ticking boxes.
Oh, yeah, exactly.
That's what their research showed that the performance of those companies was higher over time. And that's looking at meta studies, which means looking at many studies.
Did they have enough kind of whatever they did 100 or I don't know 1,000 meta like review of, did they have enough data to show a like statistically valid that there was?
Right. So I'm not a academic to answer that directly. What I do know is this professor was at London School of Economics and then was taken to Harvard after this.
Okay, I'll take a look.
Accolades. So I believe that answers.
Okay. This is to the range of investing. You know, everybody knows this. You know, so this one, you know, the other thing is, you know, the head of IMF is just saying like basically the discourse is starting to change. I still don't see the practice changing enough. Even though, you know, I think like in the US, 10% or 15 to 20% of all assets under management and publicly invested things are labeled as ESG. So it's been exponential growth. It's still a fraction of total investments. But again, it's still, to me, it should be every single dollar that, or euro or peso that anybody has should at least be thinking about this. And then just a couple of things. I mean, this is super obvious. This is based on the US stock market. So it is interesting because when I look at public markets, I mean, like to me, Starbucks, Google, Apple, they're all destroying the planet. You know, some less than others. Not Starbucks is trying to do some sustainable things, and Apple's thinking a lot about privacy, much more than most tech companies. You know, but fundamentally, and Google's doing a lot on clean energy. So like in terms of like trying to be 100, I think they've hit 100%. So they are doing good things, but they're not true sustainable companies. I look at places, and these are publicly traded in the US stock market. Brookfield Renewable, which is doing all sustainable investing, pays a really good dividend. I mean, I have stock in it. Amalgamated Bank, it's a B Corp, it's a 100-year-old union bank. So like, you know, it's also like the number of publicly traded companies to me that truly are net positive in all aspects are quite few, but they do exist. And I think most people are only thinking about negative screening or no screening, let alone even trying to screen for positive. A couple of more slides. This is interesting. I'm playing around with ChatGPT, which obviously has huge implications. So I just ran something this morning to look at the S&P 500 and just see what percentage, according how the algorithm or machine learning grouped the biggest sectors in the S&P 500. So healthcare, again, most pharmaceutical companies, I think they're so far from anything to do. I mean, we need pharmaceuticals, but I think in terms of business models and ethical practices are so far removed. Consumer discretionary, like car companies, I had stock in Tesla, I sold it all. I do have a few car stocks, but only like ones that are 100%, you know, electric. Defense, horrible. Most food companies in the US that are publicly traded, horrible. Utilities, some are pivoting. So I'm just saying, if you add this up, this is about 40% of the S&P. And I purposely took out tech companies. You know, it's a huge percentage just because we can debate if they're net neutral or not. At the end, I'm almost there. So one of the things is and I have not found, and someone might find this, I'm finding more and more, I mean, there's a lot of proprietary data out there. And most of the proprietary data, when I look at it, you know, I don't get access to their actual weightings, but I can read enough. Most of the proprietary data and the ranking systems, to me, again, are bad. Like they're kind of negative screening or just looking at materiality, but they're not looking at net positive, not just in terms of energy, but, you know, supply chain and how they treat workers, what Kate was talking about. So one thing I found, As You Sow, is a US-based nonprofit. They've been around, I think, 20 years. Andrew Baer is the head. They've got really good public screening tools that you can just access. And and most organizations and companies are not using this. And so I just ran this like early on years ago. My wife worked in gender and development. So we put a bunch of our retirement money into PACs. They are one of the pioneers in the world. But I started looking at PACs in terms of PACs has about 10 different mutual funds. And I looked at, you know, part of the problem with PACs, and she had a bunch of money in Calvert. I've had students who went on to work at Calvert. Calvert is great theoretically. The fees are insane. So you're paying super high fees for public investments. And then if you look at how, you know, As You Sow ranks, we actually had money in this years ago, we got rid of it. So fossil fuels, not bad. Sustainability, okay. Carbon footprint, not bad. Fossil finance, so they got money in banks that are actively lending. And this is up to date. I think I did this like 2 months ago. Fossil finance, so they're investing in banks that are lending to industries that are destroying the planet. Fossil insurance, the Clean 200. So As You Sow has a great ranking of the 200 publicly traded companies that are, this is the US market, not global, that are actually building climate solutions, or at least the least worst of the ones that exist. So to me, like, these companies might be good on gender. Maybe they have more diverse boards, or they're thinking about gender equity, or they're charitable giving, but like, this is not, to me, like, and I forgot the fee, this 0.51 fee, I think the fee used to be 1%. 0.51 is still too high to me for a publicly traded, like, if it's a human being helping you develop a customized portfolio, fine. But for a publicly traded mutual fund, I think it's like you're paying higher fees for something that's a little bit less worse, but still not great. And these are one of the pioneers. One of the things I consistently also find, and this is from the individual and the organization perspective, most places don't even think about fees. Or they look for like the cheapest fees. And again, most green investments, I've seen some data on this, charge higher fees, even if their product's not any better. And obviously that's going to eat up a huge amount of principal or growth that someone could have if they're investing. I just ran some numbers. I'm not going to get into this, but it makes a huge difference. So just a couple of tools, and this is kind of more recommendation. So again, we've invested in a whole bunch of FinTech and fin literacy startups. So it's been interesting to see both in terms of financial wellness, but also financial literacy and gamifying finance. So I think there's, and one I don't have ties to the founders, called Neon Money. It's 100% for the newest generation. It's like TikTok type for like making finance cool. So I think like there's a desperate need for, and there's a lot of people doing this, but the amount of financial literacy, just like, in some states are passing laws that, or at least changing their curriculum, that finance should be offered in school. Like, it's such a core thing for people to come up with basic financial, health literacy is important, but financial literacy is equal important. So like more countries and school districts should be doing this. The greenwashing is horrible. The fees, most people that I know don't even vote, they're proxy votes. So it's just like this thing they don't even know about. And so many individuals don't realize that if they own a couple of shares of stock, they can vote. It's hard to put up a proxy. A lot of people are just, I have a friend who makes way more money than I make, who works in reproductive justice, and we've been friends for 20 years. And forever, she's like, oh, I want to talk to you about finance. And I'm not a certified financial planner, but like, she's like, I want to talk to you, but I'm too busy. And then we finally sat down a couple of months ago and we looked, and she had load funds that were charging her 5% to buy and sell. Her organization, which is amazing, doesn't think about their retirement plans, anything to do with ethics or investments. And so like part of it is like, you're working for reproductive justice in the US, which is hugely important. But like, how can you not be thinking about your own financial well-being, but where that money goes? Go ahead, Matt, if you want to say something. I think you're on mute.
Yeah, okay. So I was going to just bring up 2 points and then have a short little breakout room if that's good. If
I have like one.
Else has some questions.
I got like one more. I think I have one more slide, but go ahead and make the 2 points.
Okay. All right. Maybe if you want to advance it to that slide while I'm talking. So I read a poll recently that shows people, are they should we prioritize the economy or prioritize the environment? And it goes back to the 70s or 80s. 70s or 80s, both Democrats and Republicans were over 50% the environment, actually, right? And now it's like in the low 20s, I think, for Republicans, and then the high, like the 70s for Democrats. So there's been a big split on that. But I would say that the whole premise of the poll is flawed, and it actually it teaches people the wrong thing. Is it an either or can it be, are the two tied together? So I would say the two are tied together. That's something to think about in the breakout room. And then the other thing, same thing with returns. It's not, impact investing or good returns. It could be, impact investing is actually getting ahead of some of the trends now. and it could actually be more favorable to returns. So
Yep.
don't automatically assume what the old stuff is working. So in the breakout rooms, though, I think maybe it might be useful. We'll let Craig do his last slide and wrap up, but and then like if everyone just says, hey, what can I do with my own portfolio going forward? You know, what maybe I've overlooked, and what can I actually do? So Craig, if you can wrap that up, and then
last slide.
just do a
So-
short, like 5-minute breakout room, if that's good.
Yep. So just super quickly, thanks, Matt. So PCN, my social enterprise, as you saw, is amazing. Just ETF is not bad. Your SRI, those are more European. And then a lot of the existing, there's just ETF.com. You can actually filter for sustainability ETFs. Then just one plug, one of the startups I'm most involved with is Carbon Collective, which I think is the best robo-advisor for publicly traded sustainability investing in the world. Low fees, and they're using a lot of project drawdown data. So they're like, as you saw, they have 163 of the companies that they think are either building climate solutions or contributing to a net zero, more sustainable future, or could be pressured. So they're trying to aggregate, and I scout for them. So I'm just making a plug. I mean, we've moved most of our retirement money to them, but I also scout helping them right now, not only US based, but companies or nonprofits that want to think about moving their 401ks over. Because we've been talking to lots of organizations, and they have about 100 companies that have moved over. But it's also amazing to me how many social impact organizations, doesn't have to be with Carbon Collective, don't think about where the retirement funds go, like their employees. And that's really where you can start. And there's other places doing this. There's one we've invested in, I think, called, we've invested like 3 or 4 of these types of startups. So anyway, I'll stop there. And I think, Matt, you're on mute, but thank you everyone for listening. And